In a dramatic turn of events, the global oil market has taken a hit, with prices plummeting amidst unsettling economic indicators from the United States and China, the world's foremost oil consumers. This development has sparked widespread anxiety over the future of fuel demand, further exacerbated by the anticipation of the upcoming summit between U.S. President Donald Trump and Russian leader Vladimir Putin. As of Friday, Brent Crude futures, a benchmark for international oil prices, dropped by 39 cents or 0.58% to $66.45 per barrel by 0750 GMT. Meanwhile, U.S. West Texas Intermediate WTI crude futures, a key reference for North American oil, fell by 42 cents or 0.66% to $63.54. For the week, WTI is projected to experience a 0.5% decline, while Brent is estimated to decrease by 0.2%. These figures paint a grim picture for the oil industry, with the week's performance reflecting the growing unease in the market. The Chinese economy, a crucial player in the global oil demand, has shown signs of weakness, with factory output growth hitting an 8-month low and retail sales expanding at their slowest pace since December. This data, released on Friday, has dampened market sentiment, despite a reported increase in oil throughput in the world's second-largest crude consumer. However, the silver lining in China's economic cloud is the 8.9% year-on-year rise in throughput at Chinese refineries in July. Yet, this figure is a step down from June's levels, which were the highest since September 2023. Despite the uptick in throughput, China's oil product exports last month were higher than the previous year, hinting at a decrease in domestic fuel demand. Adding to the market's woes, forecasts predict a burgeoning oil market surplus, coupled with the likelihood of prolonged higher U.S. interest rates. Bank of America analysts, in a note released on Thursday, have widened their forecast for the oil market surplus, attributing the increase to growing supplies from OPEC+, the Organization of the Petroleum Exporting Countries, Russia, and other allies. The analysts now anticipate an average surplus of 890,000 barrels per day from July 2025 through June 2026. This forecast follows earlier predictions from the International Energy Agency, which described the oil market as bloated after OPEC+'s production hikes. In the United States, higher than expected inflation and weak jobs data have fueled concerns that the Federal Reserve may be less inclined to cut interest rates next month. Lower interest rates typically stimulate economic activity, which is beneficial for oil demand. Investors are also keeping a close eye on the meeting between Trump and Putin in Alaska, where a ceasefire in the Ukraine war is high on the agenda. Trump has expressed optimism that Russia is ready to end the conflict in Ukraine. A ceasefire could potentially lead to the easing of sanctions on Russian oil supply, a development that could further impact global oil prices. This week's events have underscored the complex interplay between global economics, politics, and the oil market. As the world watches and waits, the future of oil prices remains uncertain, with the potential for significant shifts in the coming days and weeks. But here's where it gets controversial. How will these economic and political factors ultimately shape the future of the oil industry? And what does this mean for consumers and investors alike? And this is the part most people miss: the intricate web of global dependencies and the delicate balance of power that underpins the oil market. What are your thoughts on the current state of the oil market? Do you think the economic data from China and the U.S. will have a lasting impact on oil prices? Share your insights in the comments below.